Great. I think we're almost leveled out here. Welcome everyone to our webinar, How OUP Works with Our Academic Partners. My name is Kirsten Leute and I lead our university relations efforts here at OUP. Today's webinar is a bit different than other webinars that we've done so far. The goal of today's webinar is to dive into specifics around how we at Osage University Partners work with our academic partners to achieve our mission of investing in university startups and improving research outcomes, which we'll talk more specifically about later. As we mentioned in the webinar description that we sent around to folks, the intended audience for this webinar is individuals who have recently joined their tech transfer office and or are new to the OUP relationship. But we do imagine that if you've worked with us for a bit, that you actually will probably glean a few nuggets of information out of this webinar as well. So my co-panelist today is Mark Singer of OUP. Mark, do you want to introduce yourself?
Yeah, hi, I'm Mark Singer. I'm a co-founder and managing partner of OUP, and I run our tech investment practice. I've been in the venture industry since the early 90s, so a bit over 25 years at this point.
Great, thanks, Mark. And just so everyone knows a little bit of my background, I've been at OUP for just about 5 years now, working on our university relations efforts. And prior to that, I was in tech transfer for almost 2 decades. Great, so this webinar is going to include a deep dive on each of the following topics: our mission and investment model, how we work with our academic partners, including the importance of participation rights, which is something our firm was founded around, is the ability potentially to exercise participation rights, and some of the programs we've developed for our partners. And then lastly, we'll go into how OUP sources and tracks the investment opportunities we look at, our diligence process for those investment opportunities, and how we actually make the decisions on those investments. The slides that we're currently showing you and a recording of this webinar will be available on OUP's partner portal. You can see a link to that here, but also just email us if you'd like to receive it from us. It's also, this recording will also be available on our YouTube channel. Once you're logged into the portal, if you're using the portal, you'll find the downloadable presentation deck and video on the webinars page, which is under the resources section of the portal. So before we move into the content of the presentation, we do encourage you to ask questions throughout the webinar. We always like this. It's much more fun for us when we're having a conversation with the audience. So if you'd like to submit a question, please use the Q&A feature on your toolbar. For me, it's on the lower right-hand corner. We really like questions, so please send them our way, and we'll just answer them real time as we're going through the presentation. So we'll go on to our mission and model. So our mission first. So we're a venture capital firm. So return to our investors is an important part of what we do. So we are fostering deep partnerships with universities in order to invest in university startups to drive a return for our limited partners who are our investors, but also for our partner universities. And we'll talk about how we do that in a few slides. We're also at the same time working on improving the effectiveness of technology transfer of our partner universities through coordinated programs that we have, transfer of best practices, and sharing of massive data that we are able to collect. And then another one of our drivers is improving research commercialization by helping the university startups that we're working with potentially attract funding, locate management teams, build corporate partnerships, and other things. We'll talk specifically more about these in a few slides as well. So next up, we'll talk a little bit about OUP and our history of actually being a firm at this point, a fund. So we're actually on our 3rd fund at this point. We've been around since 2010, so this is our 10th anniversary this year. We've raised about $600 million across 3 funds. And across those, we're about a year and a half into the investment period of our 3rd fund. We've closed over 100 investments in university startup companies. So these are new new startups that we're investing in. And of those investments, 19 of them have IPO'd and 10 of them have been successfully acquired. We have a great team here at OUP, 18 members strong, and we'll go on to the next slide to show you our terrific team. As you can see, our team is quite broad. We have we have really one investment team, but divided into two sections. The tech investment team that's led by Mark, the life sciences investment team that's led by Bill Harrington at our firm. And as you can probably see, it may be a little bit of an eye chart, but most of our investment team, they have very, very deep science backgrounds, most of them having PhDs. And then we also have our university relations team, which I head up. And our university relations team, if we go to the next slide, is very much responsible for these partnerships that we have with our academic partners. Our academic partners sign up with us potentially in two different ways. One is as a core partner or as an associate partner. And so we're talking here about just to differentiate what core partners are and associate partners. So core partners assign their participation rights from their licenses to us for the new deal investment period of each of our funds. And so what that means is that they have agreed ahead of time to assign the participation rights that they have in their license agreements to us. Whereas associate partners, there's no obligation to assign their participation rights to OUP. We work with them non-exclusively, and they haven't pre-assigned those rights. Then there are a lot of things that are very similar between core partners and associate partners, such as both types of partners can jointly exercise those participation rights with us. So even if the associate partner chooses to assign those rights to us, we make the investment, they always have the right, along with the core partners, to be able to invest up to half of that participation right alongside OUP. We offer a lot of value-added programs that both our core partners and associate partners participate in. We'll talk about some of those value-added programs later. And then core partners with each fund have the option to renew for each subsequent fund themselves. And I'll talk a little bit about that on the next slide, which actually shows our core partners that we currently have. So we currently have 22 core partners for OUP 3. Just the things I'll remark on in this slide is that we started our fund, so way back in 2010 when we started this out, we started with 8 core partners. We've been very fortunate that each of those 8 core partners have renewed for each subsequent fund. And then as we've added partners, a lot of the core partners that we've added have been a part of originally our associate partner pool. We've seen how we work with them. We've seen the track record of their startup companies, and then have approached them to potentially become core partners for the next fund. So that's how we've built up a lot of our numbers on core partners. So let's go on to the next slide. And Mark, interrupt me if you have any comments or if there are any questions yet. Associate partners we have a very, as you can see from this slide, a very diverse group of associate partners that work with us, a very widespread of associate partners. So most of our associate partners in the US, but we do have 5 associate partners in Canada, 5 in Israel, 1 in the UK, and 1 in Singapore as well. So we have a large swath of the world that we're covering at this point with our associate partners. And so let's move on then to our portfolio, the areas that we invest in. Mark, do you want to take this?
Sure. So what you see on the slide are logos of most of our portfolio companies broken down by sector, where on the left side you'll see the tech or physical science side, and on the right side you'll see the life science side. And so we hope your first takeaway is that we invest in a lot of different sectors. So our goal is to invest in all of the different sectors where you commercialize technology, and in particular licensed technology in the startups. That being said, we do have sectors that we are more active in and sectors that we are less active in. So on the first point, again, we invest both in tech and life science companies, but you'll see more logos on the life science side. So we do invest in a few more life science companies than we do tech companies. On the tech side, we break down our investments into basically software and everything else. So software winds up being about half of our tech investments, and there the biggest areas of concentration and interest for us are areas such as cybersecurity, as well as AI and machine learning. We also invest in healthcare technologies. We invest in infrastructure software. So there's a wide range of software companies. And then on the bottom left, you'll see we also invest in lots of other non-software related tech companies that include hardware companies such as robotics companies. We've made several robotics investments, novel materials, semiconductors, as well as energy. So we're really quite broad there. On the life science side, we invest in all of the different life science categories, including therapeutics, devices, and diagnostics. But as you'll see, it skews heavily to therapeutics. So the vast majority of our investing is in therapeutics, and within therapeutics, oncology is the largest concentration of therapeutics companies, but we will invest very broadly across lots of different indications and lots of different therapeutic approaches, including platform companies as well as single kind of shots on goal opportunities. So we've got quite a broad approach. Our goal again is to look at everything within your portfolios and just pick out what we think are the best opportunities there. So then if we move on to the next slide, and this will actually answer, I think, the first question that came in: what stage do we invest in? This shows, so that was a great setup for this slide. This chart shows all of the same investments by the round we first invested in. So you'll see all the way on the left, we do some seed investing. It is a small portion of our investments, and more often we will do seed investing in tech companies than we will in life science companies. So of the seed investments that are there are a few life science companies, but most are tech companies. And then the vast majority of our investments are in Series A opportunities. So that's where you'll see the highest concentration of companies. But then across the chart, you'll see we also invest in Series B rounds, Series C rounds, and later stage rounds for the first time. So the way we think about it is that no company is too early for us to consider, and no company is too late for us to consider. Our investors, our limited partners, like this approach to a stage where we have a diversified approach, because we'll invest in early companies that have the potential to drive high returns but are risky. At the same time, within the same fund, we'll invest in later stage companies that will be less risky, generate lower multiples in success, but also actually exit sooner. And as you see a lot of the colored boxes, which are our exits, you'll see they skew more to the right side of the chart. So we're able to deliver our returns to our investors earlier in the life of our venture fund than a typical fund. So we and our investors like this balance. To then specifically kind of go into the question of when would we do seed deals and what do we look for? Most often on the left side, most of those companies are software companies with a little bit of hardware. And usually when we're doing seed deals, more than anything, it's about the management team. Like we are always investing first in a management team and second in product and technology. That's all the more true at the seed stage, because there's so much that's formative about the company. And in particular with University Spinouts, where you often start with technology and need to figure out what product to build, the team is really, really critical. And so at the seed stage, we're really looking for incredibly strong teams that have a very strong product orientation to them, not just a technology orientation, but a product orientation. And then sometimes we will actually lead seed deals or look to help form seed deals. So our team spends a lot of time talking directly to PIs about their research and whether there's an opportunity to create a company. Sometimes we'll lead those deals or we'll just participate in a syndicate. Most often across all of these companies, we are not leading our rounds, but exercising your participation rights and participating in a syndicate led by others. So with that, I think we'll move on
Mark,
to the next slide.
I actually have one question for you, and I think you may answer it a little bit later, but just because I get that question a lot from the previous slide, it's just about our target investment size.
Yeah, our target investment size is a wide range. So first, to answer the question, out of our third fund, over time, we want to have about $15 million invested in a company all the way through its various rounds to an exit. And then depending on the stage of the company and also the size of the financing round, that will dictate how much we invest initially. Where if it's an early stage company, we might invest as much as $500,000 or even less, all the way up to about $5 million initially. If it's a mid-stage company, we would invest more like the 5 to 8 million range, assuming we can initially. And then a later stage company would invest $8 to $10 million initially, and then the rest would be held in reserve. So those are our target investment amounts. As we'll talk a little bit about in detail later, to achieve those target amounts, we generally have to not only exercise your participation right, but then over-exercise those rights. So often our goal is to put in more than the strict amount of the participation right, which requires us to build close relationships with companies and have them allow us to do so.
Great. And
then there was, yeah.
Sorry, go ahead.
Okay, so there was another question that just came in asking around the question is, what does direct engagement with PIs pursuing benchtop research look like? Do you seek them out, meet at conferences, serendipity? So there are a lot of different ways we approach it. So first, our team does spend time thinking about who are the right PIs to approach. And in most cases, we first approach PIs who have started other companies before, or their lineage of people who worked in labs of PIs who started other companies before, because certain labs, as all of you know, are much more entrepreneurial than others. So that's kind of the first area of focus, which are who have shown that they have startup DNA and interest, and then we will look at their research and depending on their research, if we think that there could be a startup opportunity, we will approach them. So that's kind of one way. The second is just if we read something interesting. So our team scours lots of scientific publications. And we also just look at people's websites about what they're even putting on their own website. And sometimes we will be thematic where we'll be interested in a certain sector. So if we see something pop up in that sector, we will approach that PI directly. So there are a bunch of different ways we think about going direct to PIs. I would say the problem with going direct to PIs is the lack of a management team that's there. So usually the first step is there something interesting? The second step for us is, can we help them figure out how to pair up with a CEO or a co-founder?
Great, and we have another question in the same vein about how we navigate that, building that relationship with the PTIs and how the TTO is involved with that.
Yeah, we often do that differently depending on what the TTO wants. I would say our default is to go direct to the PI, and then without involving the TTO. And then as we'll talk about later, we have a lot of reporting that we provide our tech transfer office partners around all of our activity. And so our PI outreach shows up in that reporting, so you can see who we're talking to and the status of it. And so that's the way we prefer to do it, simply because it's the lowest friction way. It's the way we can cover the most ground talking to PIs. So some of our partner universities want to know what PIs we're talking to or want to be involved in those conversations. And sometimes they connect us with PIs. They want to actually broker the introduction. And so if that's the case, then we'll work with the university exactly how the university would like us to work and follow whatever protocol we agree on. Kirsten, would you add anything to that?
No, I think that's exactly right. We're going to work with the universities what works for them.
And let me just say, we love the questions, so please keep them coming. So now we'll talk about in a little more detail how we work with our academic partners to hopefully create a win-win. So as we started developing OUP, it was clear that we would only be successful if our partners were successful, and we became really mission-driven, not only to drive a great return for our LPs, but to drive a great partnership with each one of our partner universities. And so there are really kind of four key components of how we work with our partners, which I'll summarize now, but then Kirsten and I will go into each of these in more detail. The first is to help you generate a financial return from your participation rights without having to invest capital. So we have a profit sharing process where our universities share in our profit that I'll talk about next. So the first aspect of the partnership is our universities are taking a participation right that they generally have and historically did not exercise and turning it into upside potential through OUP. Secondly, to accomplish that, we have learned that you need to actively manage participation rights. And I would say we learned this a little bit the hard way. Early on in OUP, as we were ramping up our work with our original 8 universities and learning about their portfolios, and all of a sudden, participation rights notices just started coming in. And we didn't know the company, they didn't know us, and we had 14 days to make a decision, and we found that we could not make a informed, quick decision. We also found that companies expected that the university was not going to exercise its investment right. So if we ever wanted to exercise it, it was a surprise, and in some cases, a negative surprise. So we learned that you really need to actively manage this, and we'll talk more about how we do that. Third, along the way, we want to help your spinouts, and we want to help them find other investors, find management teams and customers. And finally, we want to help you, our tech transfer office partners, improve. And in particular, improve so you can launch more startups. And Kirsten will talk about some of the programs we offer specifically for you. So as we go on to the next slide, so first I'll talk about the financial return. So we as investors managing a fund get a % of the profits of the fund. And OUP has taken a quarter of the profit that we get and put it into a pool for our universities. So that's the financial return component, where by assigning a participation right to OUP and having OUP exercise it, a university participates in that pool. We have a performance-based formula around it that I won't go into today, but if you ever want to understand it more deeply, feel free to follow up with us. But the more, as we invest in a company, as that company does well, the more a university shares in that profit. So it provides some base level profit sharing, but then also some real upside. Should a company do incredibly well, then the numbers can get very significant. Along the way, there's not financial risk to the university. So as I mentioned earlier, our universities are not our investors, so the university does not have to put up any capital to participate in our profit. The university does retain the right to invest alongside OUP on a 50-50 basis. So should your endowment ever want to invest alongside us, we would welcome that, and we'd be happy to share our diligence as part of that process. I would say only a small number of universities actually do that. And then finally, the profit interest, while it is performance-based in that you get more as our investment in your companies performs well, it is a profit interest in the overall fund. So there's a diversification component to that as well that allows you to participate in the profit of other investments from other partner universities. As Kirsten mentioned earlier, we have 2 kinds of universities, core partners and associate partners. They share in our profit a little bit differently, where core partners get a piece of this profit sharing upfront at the beginning of each fund, because they've made an assignment of all of their participation rights in all of their companies to that fund. So they get a piece up front. And then both core partners and associate partners participate in the performance-based component. So and again, based on how their companies do, they get more of our profit sharing. So that's the financial return. And if there aren't any questions on that, we'll kind of talk about how we manage your participation rights. So as I mentioned in the introduction of this section, we've learned this is really hard, and was much harder actually than we thought it would be early on. But there's an opportunity there, which is if you can get to know all of these companies well in advance of getting a participation rights notice, you actually can get some real advantages from that. In particular, you can become a much smarter investor, and you can be helpful to those companies. So what we've made it our mission is to get to know all of your companies long before we ever get a participation rights notice. And so what it means is, first and foremost, we want you to introduce us to your spinouts as early as possible. This can be but long before a license, just as you're negotiating a license or have an option or even wondering whether or not to start a company. It can never be too early for us to get to know a company, because then we can start to track its progress. And in doing so, what that allows us to do first is make informed investment decisions, where if we're in touch with a company, we then know when it's starting to fundraise, we can start our diligence and complete it before a company has a lead investor and before it's ever sending out a participation rights notice. So we can become much more informed investors. And also it can help avoid any surprises on the company and the investor side. So they know that we exist. These companies know that we exercise our university's participation rights. So when it comes time for a notice, that historically before OUP, companies thought that the participation rights of universities would generally not get exercised. Now they know we exist and there aren't any surprises that upset a syndicate. To accomplish this, we've built a really large investment team that Kirsten went over earlier, but also we've invested heavily in systems, database systems and technologies and process to really monitor all of your activity. So we do some of our coverage manually where we're talking to companies all the time, but we do some of it digitally as well, where we're monitoring lots of information sources to get alerts around a company we think we should pay attention to. Even with all of that, we've learned we have to be prepared to make very fast decisions. And so if we've done our work right, we've known the company for a while, we've done our diligence, and then we get a notice, and ideally we know about everything that's in the notice before we get it, and we're making a very fast decision at that point, because our goal is to never slow down a financing or introduce any friction into a company's fundraising process. So we've learned to be really quick. And finally, as I mentioned earlier, we also have a goal of generally over-investing your participation rights. Participation rights can be small because they're usually 10% of a round, and if a round is relatively small, let's say it's a $10 million round, that's only $1 million. As I mentioned earlier, we want to invest more than that usually. To be able to do that, we need to show that we're value added. And so we try to help spinouts long before we're investing and building relationships, and hopefully they see that we can be a value add investor, and that enables us to invest larger investment amounts. Then it looks like we have a question, which is which I think I heard, which is, do we have a formal diligence process before exercising our rights? We do, and I would say, having been in venture for a very long time and worked with lots of other venture firms, we do have a very deep, thorough, thoughtful diligence process. So there are many companies who say, wow, you did more diligence than our lead investor. And our goal is to do it in a way that doesn't take an enormous amount of the company's time, because again, we want to be low friction, but we are very thorough. And the areas that we spend the most time in diligence are first on the management team. So that is really far and away the most critical aspect. So we will both spend time with the management team, but also dig deeply into their background, access our network to find people who know them. We also do a lot of technical diligence. And as Kirsten mentioned, we have a deeply technical team, but we're also doing a lot of publication reviews, going into actual source data, and doing a lot of technical work. And sometimes we'll reach out to PIs we know who are not involved with the company to help with that. And then we do a lot of market and product related diligence to make sure it's a market we're interested in participating in, and we understand the competitive set. So those are the main aspects of our diligence process. And then somebody just asked, will we lead around? And the answer is yes, but it's extremely rare. And so we want to be careful not to have companies really think about us as lead investors. We don't want them to count on that. And because our goal generally is if we're interested in a company, to invest regardless of who the lead is. That being said, every once in a while, there'll be a special situation where we would lead. Either it's really, really early and they don't need money and we're willing to put a little bit of money in, or we've known the company for a very long time and maybe we connected it to one other venture investor and the two of us would take up the entire round, so we would try to co-lead it in that situation. When we do lead, it's usually in smaller rounds, and just because it would be difficult for us to lead a $50 million financing. And our goal is not really to compete with the rest of the venture capital industry. Our goal is to partner with them. So we're highly selective about when we do it. And then there's another question of, have we insisted on changes to the cap table of a seed company prior to investing? The answer is yes. So I would say, compared to the venture industry at large, which can be sometimes heavy-handed and difficult and how they approach negotiations and cap tables and licenses, that is not at all our approach. It's not at all our culture. So our culture is to be highly collaborative with the companies we're investing in, with their management teams, and with the universities. So we don't march in saying everything has to be the way we think it needs to be. If ever there's a situation where we're interested in a seed round and we think the cap table is not structured right, we will talk about that and work on it. The things we would look for are to make sure that the founding management team is well incented, and that's number one. Number two, so in particular, it means the people doing the work on a go-forward basis are well incented. Second, that there's a large pool for new hires to be able to build the right team. And third, that all of the original founders of the company, which includes the university, are happy with the amount of equity that they have. And we have another talk that includes like how our initial cap table set up. You can find it in our portal, and it shows what are some kind of sample cap tables to split everything in ways that we think are fair. Kirsten, is there anything you would add to that?
No, I think that's great. And honestly, I just want to say, everyone, thank you for the questions. They've been terrific. And some of it applies to some of the slides we're going to have later on diligence. But it's great to get these questions right now while you're thinking about them, while we're talking about participation rights. So we have a few more slides now on participation rights that I'm going to dive into. First, so next slide is why participation right, why include participation rights. But first, I'm going to talk about the what. What is a participation right itself? So a participation right allows an entity, in this case, the university or its assignee, a way to protect against dilution by allowing shareholders to participate in future financing. In this particular case, the participation rights that OUP is interested in, and this is what our model was founded on, was being able to potentially exercise these participation rights in order to make investments in company. These rights are that should the company be raising around, the university and or its assignee can potentially participate in investing in that company on the same terms and conditions as the other investors in that particular round. The participation rights are very obviously important to us. It's what our firm was founded around, but one of the reasons that are particularly important to us is because it maximizes the chances of OUP actually investing in this startup licensee out of the university, because we do focus our tracking and our diligence on companies with participation rights. And again, the participation rights can ensure that potentially that OUP could invest in those companies of interest themselves. So let's go on to the next slide. So this is the standard participation rights clause that we advise our universities potentially use. The reason that we like this clause is because it's very simple. As you can see, it's a short clause overall, and it has 4 main elements to it. So the first element is the participation right itself, the ability to be able to invest alongside other investors in the round that's being raised by the company. And so in our participation right clause, our preferred clause, it is a 10%, up to 10% investment right in that particular round. And we found that 10% is actually a number that seems to work fairly well for the academic institutions. And we'll show you some numbers on that in a slide or two. The second thing is providing notification that there is this ability potentially to make this investment through the participation right, to be able to exercise the participation right. And we suggest a 30 days advance written notice, just so that we or the university or whoever will be exercising this right would have the time to be able to look further at the investment and make that decision with all the diligence that they need to get done and within that amount of time. The third item is that the participation right would need to be assignable. For us, obviously, in order to exercise this, we would need the academic institution to be able to assign the participation right to us. And the last element is survivability of the participation right. Should, for example, the license terminate, that the participation right survive that termination. But there are also a number of other things that we've seen with regards to survivability that we'll talk about in a few slides. So next slide on participation rights. Oh, we we love data. As I've noticed since I came to OUP, we love getting data. So it's data on companies, data on potential management, data just in general on venture capital and who's investing where, et cetera, but data on participation rights. And so we on the University Relations team particularly have been collecting data on participation rights. And so we actively collect the clauses that are associated with the startup companies out of our partner universities, so that we know ahead of time what our ability to invest in the company may be. Now, we do not always make investments through participation rights. Participation rights aren't always in the deals, but as you'll see in a later slide, they do account for a lot of the deals that we actually invest in. And so we like to collect this data, know what the ability is to be able to invest. And so we really appreciate, last year in 2019, we received 328 clauses from our partner institutions. This year so far, in 2020, we received 185 clauses from our partner institutions. So anyone listening to this webinar, if you've signed a license recently and you'd like to send us the participation rights language, please do. Send it to me. My contact information will be at the end of this at this webinar, or send it to anyone that you know on the OUP team, and they'll get it to the right place. The other thing that we track is participation rights notifications. So this is the notice potentially that the academic institution receives from the company saying, hey, we're raising a round, potentially you could exercise the participation rights now. So in 2019, we received 69 of these notifications. This year, we're going to blow that out of the water because we're already at 60 notifications, and I think we received like 2 more yesterday. So this is terrific for us just to know, okay, they're raising money. If we're really on top of things, which we often are, not always, we actually may already know that they're raising by the time they send the notification, but it's really important to know, okay, this participation right now option is out there, and we have X number of days to potentially exercise that right. And then one other thing is that some of you may know that in the past we were sending a thank you to the office, a box of chocolates when we received these participation rights, just because they are so important for us to know about and know what the potential ability might be to invest. Obviously, the world has changed. The world is different this year, and so we're actually donating those funds this year to No Kid Hungry. So please continue to send these participation right clauses to us. We really appreciate receiving them. So next slide. Then, more on data. Like I said, we love data. So since so these are actually the total number of clauses we received since January of 2019, divided up by institution. We haven't named the institutions here, but you can see actually that a lot of institutions have been providing us a lot of clauses. We realize that not everyone's going to have 30 to 40 clauses to send us in 1 year. They don't necessarily have that many agreements that we're doing, but we really appreciate receiving these clauses. So thank you very much to all the institutions that have been doing such a great job of sending these clauses over the last 1.5 years or so. Next slide. So a little bit about participation right information and what may make your lives a little bit easier on participation rights. So one thing is that in negotiations, as you know, no one ever wants to be surprised on a negotiation. And so I think participation rights are in the boilerplates of lots of our partners, standard license templates, et cetera. But we actually, because you often start with an earlier document with these companies, be it a term sheet or an option agreement, we have found that actually noting something about the participation right in those documents helps the company just know ahead of time that this is going to be part of their license deal. And so we have a sentence here: the license agreement will include a modest participation right to purchase equity in company and its offerings, that you could include in those term sheets and option agreements. And then because the core partners pre-assign those participation rights to us, and you often are receiving notices about those, one of the things that one of our core partners asked for, and so we had set up a special email for, is actually that the companies would notify us as well when those participation right exercises could happen. So we have a new email address that potentially the universities could include in their license agreements. And Mark, I see we have a question here. I haven't looked at it yet, so. Oh, and
yeah,
it was
just appreciating the donation instead of the chocolates.
Great. Well, we appreciate that. Thank you very much.
Yeah.
Okay. So next slide, I'm going to talk about two areas on negotiating points with regards to participation rights. And these are kind of the two of the main areas now that we've been collecting all this information on participation rights that we've been seeing, and so we wanted to talk with the group about. So there are different flavors of participation rights. So one is in our standard clause that we have provided our institutions is a percentage participation right. So basically the university or its assignee would be allowed to exercise up to blank percent of the round of the financing. In our case, we advise the 10%. But there's also a pro rata participation right, which is linked to the equity percentage that may be taken under the license. So a pro rata would be saying that the university or its assignee could exercise the participation right to maintain its current percentage ownership of the company. However, we also know that the universities themselves aren't always taking equity. They may have another form of liquidation payment, exit fee, et cetera, that they're taking perhaps in lieu of equity. But participation rights can still be in the license. And a percentage participation right is especially appropriate in those cases because it is not linked then to the equity clauses. And in general, we have found actually delinking participation rights from equity clauses causes less confusion about the participation rights and when they can be exercised and what can happen with them. And there are some other clauses associated with them as well that can help when they're delinked from each other. So if you're not including equity in your licenses, you can still include our participation right, and this percentage participation right would work in those cases. And then the very bottom of this slide is showing some of the data we've been collecting on the clauses that we've been receiving. So of the clauses that we've been receiving, 53% of the clauses are a percentage participation right, 44% of them are pro rata, and there's a few of them that are undefined for various reasons that I won't get into here. And then of those clauses that are percentage clauses, the vast majority of them are a 10% clause, right? So they're getting a 10% right. And then the ones that aren't a 10% right typically are lower than that 10%. So 22% are lower than that 10%. So just to give you some data behind what people are receiving in their agreements as far as participation rights. And so next slide then, the other negotiating point that I was going to mention on participation rights has to do with survivability. I mentioned this before. We see some different flavors on survivability as well. But obviously for us and potentially for the university too, if they have a fund, it's beneficial to have the participation rights survive any events themselves. Because for example, in our model, we're tracking these investments to help us determine when is the right time to participate. What are the rounds that optimize when we would want to make an investment? We don't always make the investment at the first opportunity when we see this startup company. We're thinking, okay, well, this company is interesting, and if this and this happen, potentially we'd like to make an investment at that time. So when we're looking at companies, we're not looking at that and saying no and we're done. We're looking at saying, maybe not right now, but in the later rounds, potentially we will be interested. I would say, Mark showed you the slide earlier of all the seed round and Series A's investments. Often we're saying yes, obviously right off the bat, but there are times when we're looking for something else to happen and potentially we'd like that ability to make the investment in future rounds. So here we just have an example of what we call a non-survivable clause, which is basically saying that if the right weren't exercised in one round, we wouldn't be able to exercise the right in any, the right would basically be extinguished and we wouldn't be able to exercise the right in any future financings. I think
okay, so we have a couple of questions.
Sorry.
Yeah.
Why don't you ask me the question?
So the first is, do we see any licenses that have pro rata and percentage rights? So I assume the questioner is asking, or do we see them both in the same license?
Yes, we have seen that where actually they will start out as a percentage and potentially go pro rata after the initial percentage participation right. So yes, we have seen that. I don't know if there's another example you want to give on that, Mark.
No, but I would say that we're open to experimentation on this. We're always looking to optimize what's best for you. and makes this as easy a process as possible and what's best for companies and for us. So there are times that we will actually do experiments or just try different permutations of this. And then there's one other question, which is, do you hear about pushback from potential licensees for including participation rights? What are the downsides for them?
Right. And we do hear this, and I think both of us can answer this, Mark. Sometimes we do, but we've often found that that they're just concerned about what does this really mean? And often if we sit down and talk with them and explain to them that basically the participation rights means someone's coming along as any other investor would with the participation rights, and also explaining about why we or the university themselves may be a good additional investor for them to have in the company, that alleviates some of those concerns. Anything you want to add to that, Mike?
No, I would say if ever there's pushback, please feel free to connect us to the company. We find it's the best way through it.
Absolutely. And I actually encourage people, the moment there start to be any concerns potentially with a participation right, just have them talk to us. We're always willing to do that and hopefully alleviate those concerns. All right, next slide then. So we're almost done with these participation rights slides. One point, because Mark talked earlier about the profit participation, we did want to make sure this point was clear to our university partners. If there are multiple licenses that are associated with a startup company, and we make an investment in that company, we make it through the participation right, it's the universities that have the participation right that will get that profit participation credit, because that's how we're getting into to invest in the company. And we have had this come up a few times now, and so we think it's important to note that the universities with the participation right are going to get that profit participation credit. However, we've also had a number of situations now, as illustrated on this slide, where the startup companies have had participation rights from multiple universities. And in that case, all of the universities get the credit. So the credit ends up being split between the universities that have those participation rights. All right, next slide. All right, Mark, this is you.
So as Kirsten mentioned, we love data. So we try to track everything about our business and our business model, including when there are financings we're interested in that don't have participation rights. So, which there are some. And what this chart shows is that the red bar are tech investment opportunities, the orange bar are therapeutic investment opportunities across time, and how many rounds were there that we felt were interesting. Interesting meaning we wanted to engage further, but it doesn't necessarily mean we wanted to invest. But there was not a participation right, so we did not have access. And the key point here is that participation rights are critical for us, for OUP getting access, and for you sharing in our profit. And our goal is to always reduce the number of interesting deals there are without participation rights by helping you successfully insert participation rights. These numbers will never be zero, though. There are some, for example, we will still invest in companies that are clearly spin-outs based in some way on research, but for some reason there would not be a license. So that would be one aspect where there might not be a participation right, or we do know in some negotiations they wind up ultimately not in the deal for various reasons. Our goal is to have these numbers be as low as possible. So we go on to the next slide. We recently have started writing up case studies of successful participation rights, because we find that there's nothing better than kind of real world experience. And OUP recently invested in a spin out of UCSF called Pioneer Immunotherapeutics. That was a successful investment. And the only way OUP was able to invest in the deal was clearly through UCSF's participation right. And so our team went back and interviewed Gonzalo Barrera Hernandez, who negotiated the participation right in, just to build a case study that you can read about. This was written about in our recent newsletter sent to all of you on participation rights. It also will shortly be in our portal if you want to go read about it. And I believe Gonzalo's on this call. So Gonzalo, thank you for your hard work on this. So the kind of the key points are the license was done in 2015. and Gonzalo inserted a participation right in it. That participation right is in UCSF's template. They inserted into every deal. And then in 2017, when the company was negotiating its Series A round, the company and its investors came back to UCSF to renegotiate parts of the license. Part of that renegotiation involved the participation right in some of the details of it, but part of it involved other things. And Gonzalo both worked with the company and its investors to create a situation that was a win-win for everybody. For example, the company in the assignment language of the participation right wanted to only mention OUP. So UCSF could only assign it to OUP as opposed to being able to assign it to others. But he also held firm and made sure that the participation right remained in the deal. And that was the critical aspect that allowed us to invest in the Series A round in 2017. And then very recently, Gilead negotiated a deal to acquire Pioneer with very significant upfront amounts and then long-term amounts that could be ultimately about a $1.7 billion deal, and all of which, and OUP's investment and UCSF sharing in our profit was entirely enabled by the hard work Gonzalo did on inserting and keeping the participation right in the deal. All right, so then to go on to the next slide. So the third aspect of the way we work with our academic partners is to help your spinouts. And we're both mission driven to do this because we want to see the ecosystem succeed. And we also do it because it's in our interest to see these companies develop and prosper, so because it creates investment opportunities for us. So the ways we try to help, first, our goal is to get to know them early when they need help. And then we will try to help them first by finding funding. And on that, we've co-invested with pretty much all of the major venture capital firms, and in most cases have done multiple investments with most major venture firms. And those venture firms are interested in our deal flow. They come to us looking for university-related deal flow because we have been methodical and organized about this. And so we like to connect interesting companies to venture firms. We also try to help companies find management teams. And third, we help companies connect with corporate partnerships. And on that piece, we have a bunch of different ways we do it. Then we just have a good network in kind of corporate America. We also have tech advisory council of chief investment officers and chief technology officers of Fortune 500 companies where we can make connections for tech companies there. So we like to make lots of connections. We measure all of those connections and report it back to you, and later we'll show you a little bit of our reporting. And then, as I mentioned earlier, we also will engage with PIs directly and help form companies. Like, our goal is to not only help companies, but show you and report to you how we're doing that. So then if we go on to the next slide. So this slide just shows some of the venture firms we've recently sent deals to. So we actively kind of manage our relationships with venture firms, and they're interested, again, in seeing deals from us. So we generally make about 200 introductions a year between your startups and venture firms, and that usually results in about 4 successful financings a year. And so this is a really valuable part of what we do for everybody, hopefully for you, for your startups, as well as for the venture industry. So this has been a really good program. And as we mentioned earlier, we measure it every year and by university, so we make sure we deliver on our goal here.
And Mark, we have
so
a
then
question.
Going on to the next slide.
We have a question on what does management team building look like, and do we use a network of entrepreneurs who are looking for something, or do we use headhunters? Or
yeah, this is one of the hardest aspects of helping your startups, and I wish that I would say we've cracked the code on a way to do this at scale, always with high quality entrepreneurs, and it's not for lack of looking. So the reality is it's manual. So it's not, we've tried to figure out, can you create a structured way to do this? And we've not found a good way. The problem being that there aren't that many high quality entrepreneurs, and most of them, if they're truly high quality, they're not necessarily looking for opportunities. So what we do in a given situation, usually, there are kind of 2 general models we will have. Number one is we're engaged with a company, the PI that we think is interesting, where they need a CEO or a head of product or something else. And there we'll both scour our network and then also scour kind of relevant companies and what companies have been recently acquired and go look for senior managers of those companies. And in some sense, we will do the kind of work that a headhunter might do, but we will do it ourselves. We generally, I think, can get people to pick up the phone better than a headhunter. So that's kind of the point approach. The other approach is sometimes we will come across an entrepreneur we think is really high quality and then just engage with them for 6 months or longer, where we'll start showing them opportunities in a wide range of sectors, both in their domain and outside their domain. And so often we'll have 1 or 2 entrepreneurs we're working with at a point in time to see if we can try to connect them.
Great, thank you. All right, so I'm going to dive really quickly into how we help TTOs continuously improve. I know we're approaching already the hour mark, and we still have actually some more slides to go over on OUP's investment process, et cetera. So we'll go over those, but hopefully if anyone needs to drop off, this is being recorded, so you can watch the rest of it later if you do need to drop off. So the helping TTOs continuously improve, this is actually something obviously that's very important to us. We talked earlier about why, so I'm just gonna go to the next 2 slides. I'll go to the next one first, obviously, to just talk about some of our programs. Obviously, we have a lot of seminars that we give in different areas to help faculty, postdocs, tech transfer offices, students, et cetera, on the entrepreneurship and startup process. We have venture capital presentations, startup presentations, pitching presentations, presentations on choosing your co-founder, et cetera. So especially right now in this time where most everything's virtual, if you're looking for some seminars to help out your faculty, students, researchers, et cetera, please contact us. We're happy to put these on for your groups. We're also currently offering virtual office hours. A bunch of our investment team members are very willing to talk with your researchers who are interested in spinouts to give them a half-an-hour session, just listening what it is that their questions are and providing some advice and answers. We talked earlier about the partner portal. I think we talked a little bit about the content, but there's licensing, startup resources, templates, example pitch presentations, a whole host of things under the licensing and startup guises that may be of interest to our partners. And then moving to the next slide, one of the things that we offer on our partner portal is actually a way to ask us about the license database. For those of you who don't know about that yet, it's a database of about 1,900 startup licenses from universities. If you're looking for comps on certain areas, saying, hey, we really want to get validated where our numbers are, or we're getting pushback on this certain area, you can call us up or send us a request through the portal about that you're looking for these comps. And then Jamie Testai, who's our license database manager, best practices manager, she can actually schedule a call with you to go over those comps. And then lastly, of course, we're doing a lot of educational webinars. We typically do about 6 of these this year. This is our 11th webinar, so we're definitely doing a lot more of those this year. It's kind of the world we're living in right now. So we're hoping to continue with these throughout the rest of the year, including we're going to have another update on CFIUS coming up at the end of October, but we'll have other ones we'll be sending out to you as well. So, Mark.
And Kirsten, we had one question
yes.
about the virtual office hours you mentioned on the previous slide, which is what do you expect the PIs to come for this? Like, or how should they be prepared, I think?
Right. You know, I think so. It would be great to actually have one of the investment people talk about this, but we don't expect them necessarily to have anything prepared. It's really, it is an advice session. You know, if they can send us, you know, some questions beforehand that we can actually, you know, if we need to look up anything or research anything or know something about the you know, particular thing that they're going to ask about, great. But otherwise, ahead of time, it's really just supposed to be a session, and there may be follow-up that happens afterwards based on the conversation itself. Anything else you want to add to that, Mark?
No.
Okay, great.
So in the last few minutes, I'll just talk a bit about our diligence process. I mentioned some of this earlier in our company tracking. So if we go on to the next slide, so this is what our funnel looks like. So we start with, you know, the top of the funnel, which is tracking all of your companies. We actively track about 7,000 private companies from our partner universities. Out of those, in 2019, we interacted with about 2,000 of them. And those interactions are either meetings, phone calls, sometimes email interactions. Again, we log and track all of this. Out of that, we went into diligence on about 230 companies, which is a lot. And then out of that, we made 11 investments. And so 11 new investments. In addition, we made 39 investments in follow-on companies that we were already previously an investor in. So all of this is a lot of activity. But at the same time, you could say that you clear from this that we are a highly selective investor, and that we view our kind of first goal is to deliver great returns for our investors. That's what allows us to stay in business and raise future funds. To accomplish that, we need to be highly selective, and so that's why we engage with a lot of companies, but invest in relatively few, although for a fund of our size, we actually do more deals than a typical venture fund. And usually we invest in somewhere between 11 and 15 new investments per year. And so that's kind of the way the process works. So you will often find we'll talk to your companies, but not invest now. But when we're not investing now, it doesn't mean we're not investing in that company ever. We then want to track it for future rounds as well. So we also track the sources of the top of that funnel, of where do we find out about companies. Our goal is to find out about as many as possible through you, our tech transfer office partners. So we will come and meet with you and your teams throughout the year to report on our activities, but also to learn about your new companies, and then hopefully have any email interactions during the year where we frequently learn about your companies. Some of our universities have automatic notifications in their databases. When they create a new startup license, we get an automatic notification. That works great. So this bar chart shows the sources of of companies that actually entered the diligence process for us and where we learned about them, where the tallest bar is from tech transfer offices, but we do learn about opportunities from other areas. We scour news sources, we have VCs introduce us to deals. As I mentioned, we go direct to PIs. And so sometimes this means we're learning about companies before there's a license, or perhaps it's a company where there's not a license. So we do try to manage as many sources as possible to find out about all of your direct license startups and also kind of your startups in your ecosystem. So then on the next slide, as I mentioned earlier, it's never too early to introduce us to one of your companies. And as we talked about, the main reason why is so we can intelligently exercise your participation rights without surprises. It also allows us to get to know a company, and in particular the management team, over time, which we think makes us smarter investors. So we try to, the moment you introduce us, we will stay in touch with that company all the way through its life. And what you'll see in the pie chart on the right is that we've tracked many of your companies for a long period of time. Over half of the companies in our tracking database we've known for over 3 years, but 16% we've just gotten to know this year. And if you look at our investments kind of track that. Sometimes we'll invest in a brand new company where you've just connected us and just done a license. And then sometimes we'll invest in a company that we've known for 4 years, where maybe we actually said no to a previous financing or two and then invested. So, and our goal again is, in particular, as we track companies over time, to build a higher and higher comfort level with the management team. So then the next slide. So then, we try to report all of our activity back to you. And so if you have not seen it, this is the cover page of what we call our deal log. This is what, when we sit down with you in your tech transfer office, what we will report back to you. Where the first page, this is for a fictitious university, so all of the names here are not real, but we'll report back to you how we evaluate the quality of your companies in the upper left, the companies investments we've made in the lower left, the sector. You see in the bottom right the number of introductions we've made on behalf of your companies, where we learned about your company. So we'll give you a bunch of high level data. And then on the next page, we will then go into a company by company reporting of our status and interactions with all of your companies, where you see in the active tracking section here, again, this is fictitious data of our interaction with each company when we last contacted them. You'll see our notes. And so we'll give you real-time reporting of what we're doing so you can track our progress. At the top of this report is a section for new companies that's always blank, because that's where we want your help in getting to know your new company. So this is something we aspire to do periodically with all of our tech transfer partners. So with that, I think that we are done with talking about OUP and how we work. Kirsten, is there anything else you want to add or close with?
No, I just really thank everyone for so many of you sticking with us over the extra time that we had today. And thanks for coming and learning some more about us. If we haven't answered any of your questions, I don't see any more questions. Oh, actually, there's one more question coming up right now. Actually, this is just a thanks. That's great. But if there are any more questions, please do reach out to us. You can see both of our email addresses here, or reach out to anyone that you may already know at OUP. We do have a survey that will either be popping up in your chat box or will be when you exit out of this presentation, it'll come up. Please answer the survey. It really helps us decide what we're going to be doing on future webinars, and not just webinars, but also those programs I mentioned before. A lot of our programs are direct results of suggestions that you all have made to us, like what would be helpful to you, what crosses our world as investors and your worlds as the tech transfer offices and the operations that that you're working on. So we really appreciate all the feedback that you give us. We very much view this as a collaborative process. So thank you for doing that. And anything else, Mark, that you wanted to mention? And I'd like to thank you for being here today.
Yeah. And thanks for having me. And Natasha did just post in the chat box a link to the survey, so if everybody could fill that out, it helps us learn.
Yeah, great. So thank you everyone for joining us today. And we hope to see you at another webinar soon, or send us some emails. Take care.